Welcome everybody. Today I'm going to talk about interest rates. Interest rate theory in terms of our perspective and what it means and why you're facing a strong dollar right now. What it means for different markets right the way from crypto, gold and silver. Don't forget we've got a slam down after our last video, the most important video, on the Friday afternoon close. We're going to have a look at silver and gold and how we see it going forward. Is that it? No, it isn't. We'll be telling you more right now. First, let's start off technically, by the way, with going straight to the 10-year and having a look at interest rates, US interest rates, one of the most dominant treasury bills. I remind you in terms of the final quarter of last year, of the 7 trillion that was created by Granny Yoda Yellen, and say to you that this is inflationary, new debt creation, and where it all went is inflationary. So now we find ourselves here looking at something and you're seeing the interest rate curve go up. So just a quick reminder, this particular chart, after this capitulation low, which was in and around 0.3 in rates, which was a hyper valuation for debt. In other words, that was peak bonds. We called for the end of the bond bull market and said, in actual fact, from here on in, you're going to continue to squeeze on upwards. And that, contrary to all the narratives that we're just a few months away from a 7-rate sell-off cycle, at least 3 in the current year and potentially 4 in the next. That was the pivot talk that took us through 2021, 2022, and even into the first half of 2023, where everyone was, it's just a matter of time. They will all be at it and printing. However, the rates went right up to 5.5. And in actual fact, it appeared on the surface that nothing broke. Of course, fiscally, as we pointed out, our fire and water, our petrol and water scenario, they were pouring petrol at an epic rate on one end of the fire while being seen monetarily by interest rates to put out the other end. What this actually does is just walk the fire along rather than put it out, because they knew they would have precipitated a major crash on the 5.5% rates if they weren't also simultaneously issuing new debt. So what's happened on rates? So this turn is part of a much bigger cycle of reversal in rates. And the point we've made many times before, let's go up to the monthly on this 10-year rates, is that you've come down from a very, very long way. That takes you all the way back to the Volcker years. The Volcker years, that's right, way back then. And these were at rates continually down. This was your bond portfolio and your equity portfolio. Bond covered you when the equity market sold off. Your 60-40, never felt so good. Well, that of course came to an end when you had a terrible debt and bond market. And that all transpired with the snapback rally. This is adjusted for log scale. So you can see in percentage terms what a huge move in the opposite direction this is. Trends end with a final capitulation. That was your final capitulation right there. And that is why we were the first, and it was our first time calling the end of the bond bull. Absolute spiller, a thriller all the way from Manila, and smashed it down. It did. And then upside snapback with further upside coming. So that's your history. We're coming to the point where we need to remind people, and everyone was still saying, we're going to pivot, we're going to pivot. Let's bring it right down to the 4-hourly, and this will illustrate how rates have moved. We've got Reuters right here popping a box up to tell us 10-year yields hit a fresh 5-month high after the Chinese GDP data. Well, they'll have a reason for it every time. I'm also seeing on other alerts that retailers are buying like gangbusters. Over here, let's have a look. It's the Daily Shot. Robust retail sales intensify inflation concerns. So you're going to hear it's China, it's retail sales. You're going to hear everything but central banker proliferation of the currency, devalued it and created thereby inflation. That's the one thing you won't hear. And that is the thing. In fact, that entire bull market in bonds was built on ever lower rates, allowing ever greater expansion because interest rate payments came down. You put that hand through that tight jar, you grabbed all the sweeties, and now you're trying to come back up. Well, I'm afraid with a handful of sweets, you're not getting out of that tight neck in the jar at all. And this has been the thesis of our interest rate theory spike, which will probably be driven by the Fed, because they've also just done the greatest proliferation with 7 trillion, and that was last quarter last year. Imagine what they've done first quarter this year. Don't forget all the policies that they've pursued, the BlackRock type policies, DEI, ESG, unending immigration, flying into New York, flying in everywhere, putting up in hotels that BlackRock happen to have, or homes that have recently been purchased by BlackRock, giving some chosen ones some hot cash to go buy future homes in what once was Gaza. That's right, that's what's going down, my friends. And this has suddenly escalated really, really firmly. And most people were still in the cuts camp, and that you're going to continue and move towards a cycle of at least 3 cuts. Even we felt it's possible you're going to get 1, maybe even 2. But we always felt higher for longer, and in actual fact going into a loss of value for debt markets, into a contagion spike, which will probably drive the dollar. And that dovetails quite conveniently with theories like Ben Johnson's dollar milkshake theory. So interest rate spike theory actually understands and allows for dollar milkshake theory inside of an environment where actually the super dollar is in fact gold and silver, and in spite of whatever the dollar does, it is the loss of valuation on huge debt markets, far larger than all the market caps of all the stock markets, by the way. Money is borrowed into existence and then distributed through a banking intermediary. So this will see bank failure, it will see fiat major spikes, and the first to get hit will be those emerging nations that have dollar denominated debt. Think of Perkins and the economic hitman. That's the game. So they will have to proliferate currency, a higher rate to pay, and dollar leading the charge by raising rates, which will see the role of the Fed, will turn the pressure on emerging market nations, and you'll see other currencies do, the likes of the Turkish lira. Another example of such would be the South African rand, for example, would start to do a bit of a Turkish lira maneuver, and that would be consistent devaluation in the rand. That devaluation in the rand will see them have to print more rands to meet their dollar-based debt payments, which further devalues the currency. It's a cycle. Rather than bringing you into balance, drives you to the extremes of hyperinflation. It won't get to hyperinflation, that's beyond double digits, but it takes you into stubbornly high inflation in a very low growth environment, which is how most of you should be feeling if you're not part of the military industrial complex, the pharmaceutical industrial complex, the climate industrial complex, the woke industrial complex, and any other green industry that is currently supported by our friend Larry Fink through BlackRock. Anyway, this rate increase is going to catch people by surprise. And in fact, we are seeing credit cards now averaging 21.5 and the highest level of delinquencies in credit cards. So we speak of the clown's bubble that has been twisted, and there's one economy for the Magnificent Seven, the statists, surveillance. Of course, there was a great tweet come out about how Reuters will be paying $6.4 billion to Samsung to print chips for the military industrial complex for all of these. Those are the corporations that do very well. It's the government giving contracts to the defense industry, crowding out the private business world to actually weaponize those chips against you for track and trace and everything else. And of course, military, which is going to be given probably to Ukraine, Israel, and sold to Iran so that they can blow up each other to varying degrees of successfulness and repeat the cycle, and the banker wars get ever richer. One thing I would say with this cajoling and non-condemnation by America on the political side is you rarely have people coming to you saying, go and hit that other guy. People just wouldn't tolerate it. But for some reason, we allow it at a nation state level. You've got to hit that guy and it's justified. We need to go to war on this. Of course it is. It's part and parcel of inflation. The war will provide further inflation, lead to further printing, to do further bullet building, missile building, chips for weapons, etc., etc. And you go without new infrastructure. You go without new infrastructure and you get told we need to pay more. You've been consuming too much at a time where you've barely been consuming because green. How are those wars actually for the climate? Are they good, do you think? Leaving depleted uranium lying around? And of course, blowing things up, leaving lead and all of that, and the manufacturing process thereof, and the people that scratch around in the dirt to bringing all the minerals from Africa. Not very good at all. But nonetheless, this is the interest rate theory, and we predict that you're going to continue to see, as we have done for a lengthy time, stubbornly high rates into an eventual interest rate spike. So this 10-year on the 4-hourly has been moving up, and as thank you to Reuters, they told you it was the highest it has been in the better part of 5 months, with potential to go higher still. What happens to the other first world currencies and countries? Well, let's not forget that the US dollar has now broken the 152 on the Japanese yen. We'll probably go past that in a minute. But let's have a look at some other countries' debt instruments. Here's the British pound. And we have many friends in the UK watching the channel. Hit us a like if you're from the windswept Shawshank Island. That's right. Hit us a like right now. Are you enjoying your WEF-based politicians? Are they serving you well? Or have you thought and considered it might be time to shuffle off someplace warmer, someplace more south, someplace away from the dogs of war? Maybe that thought did occur to you. Maybe you thought maybe it's a bit too difficult. What about the kids in schools? I say keep thinking that thought. Hold on to it. So here you have, with courtesy of our amazing HVF draw tool, you have an upside HVF in rates on the 20-year government bond. You're hearing it here from me. 20-year debt market bonds right now will go through 7.5%, currently trading 4.7. You just heard the market sniper say you're going to go through 7.5%. On balance of probabilities, there's no guarantee, we can and will be regularly wrong, that rates on 20-year British debt will go through 7.5%. And by the way, if they lag the Fed's rate climbs like they did last time under Bailey, they'll be throwing a new prime minister and a new financial chancellor under the bus to escape again for their sins. I think this time they'll match America's increase. Otherwise, pound horribly down and no bid for their debt, as people that can hold any nation's sovereign debt decides, I'll take the higher interest rate and the stronger currency. Thank you. And that tends to be what happens. So you don't want to be the weakest weakling in the room in the debt market when everybody is casting a jaundiced eye over a deadly financial industry of debt. You don't want to be the worst. And they just give you one little glare and you start pipping in your little British pants. You will be pulled out and dumped summarily. So watch it, watch out. The debt interest rates are going to be climbing. Those that need to sell properties better do it quick in Britain, Australia, America, the West, all over the place, because as rates rise and everybody relies on a mortgage, so few cash buyers, prices will have to fall because new buyers will not get fixed deals at the old rates of what at the low end of the March 2020 when they were giving money away for next to nothing as a price of capital. No sirree, Bob, you will be looking at far stronger interest rates. Your payments will be far stronger. You will be sitting on credit card delinquencies that are going through the roof right now in America. The banks will be potentially not in a balance sheet position to even lend in the mortgage environment. They could be themselves facing ultimate failure as, let's not forget, the intermediaries of a failing debt and fiat system. Your cash balances in those banks are better held in cash notes at home in a possible event of crisis. And of course, for real preservation, I think gold and in due course silver could serve you very well. However, they will go down in a demand destroying event And speaking of demand destroying event, which we've spoken of before, we will have to revert also and have a look at those yield curves. The yield curves. Many people lose. They get lost on yield curves. It's quite simple. I'll make it easy for you. You don't have to strain and say, that's boring stuff. I don't understand it. I won't do it. Remember this. Mark this chart. 7.42 is our target. Here it is. I'm drawing it for you in bold. That is where the British debt market will be on the 20-year government bonds. It won't be next week, it won't be tomorrow, but believe you me, once it really starts capitulating and collapsing, it can move pretty fast. But that's, as you can respect, a very, very big call on rates. Going from sub 4.75 to claiming it's going to go to 7.5 is knocking on the door of around 60+% call in rates after you've already done a major advance in rates. And it won't be because the economy is so hot. It will be because the debt is so heavy and going down. That's how it works, friends. Remember the seesaw of valuation versus rates. Valuation go down, rates go up. Valuation go up, rates go down. We have a glut of debt. It's getting bigger. And of course, every nefarious military activity, not to mention the pharmaceutical variety that they propagated on you already, all of those are being costed out and put on the tab. Put on the tab of debt, and there is a debt bubble. There is not a property bubble, there is not a Bitcoin bubble, there's not a gold bubble, there's not anything but a major debt bubble. And when it bursts, you will face most markets that are financially engineered, such as vehicles, cars. You bought that sports car with, you leased it on a 7-year deal where you pay back 40% of the value over the 7 years and a balloon payment. My friends, they'll be handing them out for anybody who still has his cash for a fraction of the cost. That is the way of the world when this debt bubble will burst. And it is not far off. And if this occurs, I can say to you, car finance is going to get real sticky. Home finance is going to get real sticky. Everything that has borrowing and lending, and at the same time delinquencies will be through the roof and banks will be near bankrupt. Good luck trying to get a loan for anything, even if you can pay the rates. Prices will be forced to fall. Asset devaluation, demand destroying event will then occur post a major rate rise surge. Let's have a look at that yield curve that I was talking about. So very simply, for people that don't want to understand things that sound too complex, is really it's the difference between long-term debt and short-term, where long-term debt, borrowing for a long time, should cost you more because the compounding of inflation devalues that money far more over a longer duration. Duration kills when there's compound interest involved, my friends. That's the 30 minus the 2. I'm going to switch the eye back on. You can see where the 0 line is. Those of you that are watching will know what I say about the 0 line, the demand destroying event, the DDE as we call it. Nothing wrong with a pair of double Ds, I say. I'll provide the E. Anyway, you come in on there, that Boeing popping up, we're looking for a third impulse. You'll pop through at least towards the 0% and possibly through it. At the point that a yield curve reverts back positive, the 0 line, we have been in an inverted yield curve since way back then, 2022. You can then pop all the way down. We've been so heavily inverted, it's transcended most of the modern era, post-Volcker 80s. Inversion. So just to give you a little look-see on that, that's how deep we dipped. These are yield curve inversions with their associated crisis that we've shown many times before on this chart. This is the deepest yield curve inversion. This is the perversion of the state of the debt market. It is extreme. By the way, CV19, you only just got a small dip above, then you got your crisis. The crisis follows the dip Once you revert back positive, that is when the long-term rates are now paying and charging a higher interest rates than shorts, which is how it normally should be. This is the great big normal. Yield curve inversions are a rarity and a sign of real problems. So when you go down below this blue line, that is a future problem coming to bear, and it comes to bear on reversion back positive typically. And we are seeing upside potential setups on the yield curve reversion as I'm showing you here. And in fact, we can draw one for you. This one's probably the best. This is 10s long term. So 10 is long term, 20 is long term, 30 is long term. 1s and 2s are short term. This is 10s minus 1s as one of the yield curve inversions. And as you can see, the strengthening of the 10-year is the beginning of the youngest of the long-term debt starting to get higher on yield. Wait till that trickles through to the 20-year and the 30-year as it should, and you will see similar reversions upwards towards reverting back positive on the yield curve inversion. That is an upside HVF. We are calling for the next move on the differential between the long and short, the 10 and the 1, and saying that this already offers us a target of below 0.3, negative 0.3. So you'll be minus 0.29 or something before you have a little bit of a rest as part and parcel of a journey. When you're at 1 point, minus 2.1. Yes, it's a spike. You were minus 2.1. Over here, you were minus 6.3. 1.63, by the way, minus 1.63, minus 2.1. Now you are less than minus 0.1, you're at minus 0.53. So only 0.5% negative in the difference between the 10-year and the 1-year. You just saw Reuters pop up 2 minutes ago on mine telling you how the 10-year, the long term, is getting higher. As it continues to get higher relative to the short term, the difference between them will go from being negative and head towards being positive. Unless the short term rates start climbing as fast as the 10-year does, then it will stay the same. Not likely to happen. This is not what's going on. We are going to move back and move towards a yield curve reversion. So we are on borrowed time before that. It's not immediately, it's not next week, it's not next month, but it'll be interesting to see where we go. And as I've said before, suddenly things can happen real fast. You can wait decades for anything meaningful to happen, and in weeks you can have decades of things happen. That's how it is, that's how it is, that's how it is. So this yield curve reversion will be downside for most things except cash. You want to have cash for then, but in the meantime, you want to have gold and you want to have silver. Time to look at gold. It got slapped down on Friday in the last hour, shortly after our last video release, which we said is the beginning of the focus on preservation of capital rather than return on capital. Why? Because return is a yield instrument that is interest rates determined, and it has the corollary of debt going down in value. There's no point making a yield on something that's capital value is exploding. If you bought a $500,000 house and you could rent it and the rent could go up slightly higher by 10 or 20%, but the house was devaluing by 100,000 every 6 months, you would lose all your money despite the yield improving. Okay, so we do not give up capital in the name of getting a marginally better yield. That's being penny wise and pound very foolish. Gold, let's talk about gold. So gold got its slap down, but look at what it's done. And we said this is a breakout long time ago. Many people barely accepted that it was a breakout. There's quite a few anti-golders, it seems, suddenly. They all want to be in something else, or Bitcoin, or gold hasn't moved. They want to bring all their old stories. I'm going to be showing you one of the most bullish charts on gold again, because I showed it to you last time, but I need to remind you, this was a key break from the 2K. Once you broke, you sat on it and then you pumped. We, of course, gave you this upside HVF and said, expect outperformance on that. This is literally a boat with its keel in the water where the 2K level was, and that once you leave this, you will not be seeing it again. I think I feel a whole bunch safer about that now that we've knocked on the door of 2,400 and are the better part of $400. However, if we had a huge enough demand destroying event to the downside, that could indeed see possibly, I don't think it'll be too easy for it to happen, but depending on the scale of the event, you could have on gold, like anything else, a pullback if we are talking about reset crisis. In the event that that occurs, by the way, gold and silver as capital preservation and intrinsically held will go up and return far faster like it did during CV19. So this is a very key aspect that I really want people to truly understand, that this gold will be the best asset for bridging. However, there will be a period where just having cash, provided it is still accepted tender during a crisis, will be the outperformer of everything, because everything else is disinflationary, being affected by that demand destroying event. However, until then, and as I pointed out, the demand destroying event and the reversion back above zero is not imminent. It looks to be a couple of months off, potentially, unless things move very quickly. It could even be 6 months off if we chop around a little bit. It could even roll into next year. So what do you do till then? Well, you watch this YouTube channel, make sure you've subscribed. Are we going to be making a new high? Are we going to revert on the yield curve inversion? It's a 100% indicator. You can have a look at all those other examples where it worked so well, and we will update you as it reverts positive. It'll be probably our second most important YouTube we'll ever release, demand destroying event. That will be a real good time to be in cash and out of your banks. By the way, you should already start thinking about that, being less exposed to banking institutions and having more precious metals. But as we've already said, PMs will still be affected. So how did that slap manifest? Let's have a look at it. It was super strong. It was obviously derivative based, I would imagine. And you're looking at the subsequent rally after a dip down to 2323. It's actually been largely shaken off. It has taken a small amount of the fluff. We would say there's a bit of a broadening structure going on here typically, and there might be a need for a little bit of a calming period. Don't forget, you've come all the way up. All the way up from 2000. You've got put on the better part at its peak of $400, $430, I would argue. And now we are sitting on a squeezy that could square up and start going again. It could do a couple of things. It could also do a falling wedge, which could shake off the downside. You could do something like that. That could see you make marginally lower lows. All the people, when you run this low, lots of technical stops, I imagine, would be sitting in and around this zone over here. Could do just enough to spike them out, bounce, and then break to the upside. That could be very typical of a possible eventuality. One thing we have reported as one of the most interesting charts to be followed is the gold-silver ratio, and we've told you it's one of the key triggering events. Again, they seem to be just doing enough to keep this from breaking and staying down. We've had one other event where you had multiple candles below the grinding line, the basing ascending grinding line. That was over there. So you've got multiple candles there. That was the third, and this is probably the fifth. That is the fourth. You got the second and the first over here, where you wick only traded through it. So these were relatively small ones. These were all relatively small ones. These two have been pretty damn big. You've just had a big one. And let me say, this still requires gold to be outperforming silver to bring it back into the lower half of this range. Were there to be at any point silver starts to overperform, you could be back down and you could still break. So we are dancing the line. We're at a high state of alert for the gold silver ratio, but at the moment it looks like it could be another one of these. Will it rally so strongly? Well, that's going to be led by the central banks and gold buyers. Generally, if they are over prioritizing gold, and in this environment, it could indeed be. It could indeed be. But the range break of this big ratio, the day draws nearer. Remember, with each passing day, the benchmark gets higher. Up top here, we're at 84. Down there, we were at 75. In the meantime, both have gone up measurably, however, gold more so. Both have gone up measurably, however, gold more so. This is going to have to be the ongoing theme until such time as the gold-silver ratio breaks this basing ascending grind line, stays below it. It can have a return move, but then it will be an absolute spill and we will be to the races. I continue to warn you of that and say this is just one candle. We don't know what Thursday or Friday will hold, or Wednesday. We'll have to see how that all pans out. Okay, till next time, thank you for watching. These are the key drivers and how you should be positioned. Preservation of capital, gold bullion vault link below. Booking a call to maximize your wealth in reset season. And boy, is it reset season now. My friends, you are arriving just in time. Booking that call right now, you will be part and parcel of what we are aiming to do in this gold and silver market that should bring bear great fruits. We have been long. Let's do a small little epilogue. The coffee market, by the way, we have been long the Arabica coffee market. It has been doing swimmingly, as well as the silver and gold that we spoke to you about. It's Casey and the Sunshine Band. Remember them? Let's go there. You can see this fella. That is one of the ETFs. We did the 3 ETFs with 50% plus moves that are all showing you, in spite of a strong dollar, coffee has continued to trade higher. Hold on a minute. In spite of a strong dollar, these commodities are running and breaking. You've already made the HVF target. You are now in the W bottom game, heading for, you guessed it, the 290-300 zone, which will be the point that technical pattern would have played out to its fullest. Go and have a look at the cocoa chart. Go and have a look at the Robusta coffee chart. That's the coffee Robusta. Look at that fella over on the daily chart, how it's been moving since the 1700s, now over 4,000. Guys, it finished 2022 at 1768. It is 4095. How much do you think your super rough cup of coffee you're going to get from Schmuckbucks? By the way, if you go to Schmuckbucks, the promoters of the ESG, the transgender place, you're guaranteed to get coffee, but you know what? It's a bit like going to prison for sex. You know it's going to come at you real rough. But generally, if you make it at home, which I suggest you should do, it's going to be a whole bunch more expensive for you there as well. So just wonder and think about what your brew is going to cost you in the likes of these places as coffee is doing this. Not to forget about cacao, which is the ultimate barnstormer so far, COCOA, and you can see that chart along with us over here. And boy, oh boy, is that just one. In fact, let's take that DC. That is an absolute monster. That is an absolute monster. Just to highlight on that one, 2,194, September 22. You could have still got in at sub 4 grand in November, December 23. Over 10 grand today. Over 10 grand for the same weighting. You were 2 in 22. How do you think those chocolate bars, those chocolate ice creams, there's anything that has cacao based flavoring is going to respond? This is really, really hyperinflationary. And this is going to continue to drive the inflation numbers up so that you get headline retail stronger than you expect. You'll think you're the only guy not making money and everyone else is all rushing off buying Balenciaga. No, they're just paying a whole bunch more just to get the same old goods they always got. That's right, friends. That's your inflation. That is the proliferation of fiat that Yellen has been bringing down on your heads. That is the destruction. And America will be the first to turn the heat up on the interest rate spikes to lead the charge, and the others will be obliged to follow. This is what's driving the dollar up at the moment, which we didn't cover, against, let's do the chart for the USD JPY. There was me saying goodbye. There's so many lovely things we still have to show you. FX, there you go and have a look at that yen chart. There you go. I'm going to remind you also, look at that, 154. It's an absolute melt up. It is deep, deep trouble. Look at that low volatility squeezy. Yep, it is a runner. It is a runner. We saw it, but it's an absolute runner. And look how much it's done. Do you think the Japanese, with their 0.1 increase to signal no more yield curve, is going to do great when instead of getting 3 rate cuts at 0.25, those are all being taken off the table? And essentially, America is talking about reining back 0.75. It makes Japanese stepping away from yield curve control at 0.1 look very, very little pippy. And that is going to hurt them hard, hard, hard with the loss of value, further loss of value on the yen. This has been dollar driven. Don't forget the big trades that we've also shown you as a reminder on the FX side, as we pull up those charts as well, the USD ZAR, and then our final favorite, the Korean won. We will show you those as well. Here we go. Here we go. This one is coming back up over here. Now, it's been a little bit of a choppy mess, to be frank. But eventually, we would imagine that if this current level of behavior continues, you will have an upside break in the Rand. That will take the Rand through to 21.62. Don't forget, indebtedness in dollars, not a good thing in a rate tightening environment. Means you have to print and create more of your money, or you have to sell a whole bunch of goods to America that recessional Americans aren't going to be buying. Then finally, our Korean won. In fact, I see it up top there. Let's put him on. This little fella didn't half get a bit lively just recently, and that's it right there. Also in an upside HVF structure. And we'll remind you that this particular setup is edging ever closer to its traditional entry on a 3-monthly mega structure with a super spike in it. That's right. That will be the yield curve interest rate spikes that will be driven up. The Americans will respond first to up rates to accept the fact that their huge debt is devaluing at a rapid rate. I warn you, 40 years of escalator is not unwound with another 40 years of downward escalator. It is 3 or 4 years of elevator, and you're already in the 3rd and 4th year. Okay, that's how it goes. Don't forget this big macro setup that we have shown you many, many times on the Korean one. We haven't spoken about it in a while. It's a big time frame setup, and it looks something like this. Boy, oh boy, isn't that going to hurt the Koreans when that one comes to town? And what will you be looking at? Around 2,740 super spike. And for those of you that say that's never, ever happening, let me just remind you of the last time we got a squeezy Japanesey. Don't forget that Asian crisis over there, right there. Boy, oh boy, what a move that was. What a move that was. And then you had this move over here, and we are now just crossing the funnel for that just-in-time entry. Do not miss these great haymaker trades that will be driven on dollar strength. And let me remind you, as strong as the dollar will be, gold, silver, the preservation of capital in physical form will be outperforming. One of our big markers were when dollar goes up and gold and silver goes up too. You've already seen a certain period of that happening. Here you go. Those are your big FX trades. This is the reason why. This is interest rate spike theory brought to you by the HVF method, guys, that called the end of the debt market in the year it happened, 2020, when no one else believed us and we're still talking about buying bonds and wearing diamonds. Both are valueless in my opinion. Until next time, I catch you later. Many blessings from Sniper Central. Don't forget to hit the like, subscribe, and click that first link to book a call. And if you want to buy precious metals, use the pure gold link. Pay what I pay, deal with the people I deal with. And I will never affiliate anybody that I'm not happy and getting excellent service from. Till next time, catch you later. Bye for now.